From the opinion pages of the Wall Street Journal, this is Potomac Watch.
The Federal Reserve raises interest rates again, and another regional bank runs into trouble after the failure of First Republic Bank earlier in the week. Is the banking system as safe and reliable as regulators say it is? Plus, could the Federal Reserve itself become an issue in the presidential campaign? Vivek Ramaswamy wants to make it one, the Republican presidential candidate. So could he do so? Welcome. I'm Paul Gigot with the Wall Street Journal editorial page, and I'm here with my running mates, Kim Strassel and Joe Sternberg. First, let's talk about the Fed decision to raise rates to 5 and 5.25%. That's the 10th increase in 11 months. Seems reasonable to me that they did so, with hints that this will be the last increase for a while, not a firm commitment that there's a pause in raising rates, but the market seemed to think so. And Kim, I don't know, what do you think? Are you feeling that this is the proper position to take, given the relative decline in inflation here in recent months?
I think it's at least reasonable. And look, if you go back to the last Fed meeting in March, they suggested that they were going to do at least one more, maybe two. There had been a lot of pressure on them, including political pressure to not even do this one, to stop just earlier this week. But prior to Jay Powell giving his talk yesterday, you had a group of Senate and House progressives that all came out, Elizabeth Warren, Bernie Sanders, just hammering the Fed, saying that the Fed's monetary policy strategy is triggering a recession. It's going to throw millions out of work. It's going to crush small businesses. So the political pressure was there. Wall Street was there pressuring them as well, too. They could have pulled back even back in March when the banking crisis was going on, but they stayed the course. And now, given some of the questions that are out there in terms of the hiring market, layoffs, credit tightening, it seems at least reasonable to take a moment and pause, especially given that, the benchmark federal funds right now is probably between about 5 to 5.25. And the last personal consumption expenditure inflation rate that came in was about 4.2. So maybe they're ahead of it at this point. Still a long way of inflation, way ahead of the target rate, but there are some signs that it might be coming down. So yeah, I think it was reasonable to take a breath.
Joe, the paradox of this economy, that even though rates have gone up so rapidly in 13 months, there are some problems in finance, but the overall economy, and especially consumer spending and the job market, keep holding up. We get the jobs report on Friday for April, and people think it's going to be reasonably robust. I don't know if that's true, but it's certainly true that there's no recession so far, which is a blessing. It's been a blessing for Jerome Powell and the Fed, because it means that they've been able to raise rates without too much political opposition.
Yeah, and I think that what's going on here is that the Fed increasingly doesn't know what it's doing, and I mean that as an observation more than a criticism, just because the economy is not reacting to Fed policy in the way that the Fed models had predicted that it would, and I think that increasingly seems to be causing a lot of confusion, both on the part of the Fed itself and also on the part of the markets trying to figure out what it's going to be.
Let me interrupt you, Joe, there. When you say that the Fed doesn't know what it's doing and the economy hasn't reacted to what the Fed models suggest it should have, what do you mean? What did the models suggest that it should have done?
What they thought that they were doing at the beginning of this tightening cycle was that as you increased interest rates, that would slow economic activity, that would weigh on the labor market, and then more unemployment slack in the labor market would control inflation. Now, what has ended up happening over the past 12 months is the inflation rate does seem to be slowing down, although it's still very much above their target. So prices are increasing, but you have not seen that effect in the labor market. In fact, we have managed to bring down inflation without necessarily weighing on jobs or job creation in the way that the Fed models would have expected. And yet you're also now creating financial stresses, which is something that the Fed's model of the economy don't usually account for, without seeing this, recession in terms of GDP, although GDP growth has slowed down.
But the job market is 3.5% unemployment? I mean, it's still millions of unfilled jobs out there.
Exactly. And, I was struck watching Chairman Jerome Powell's press conference on Wednesday by exactly how confused the Fed seems to be about these developments. Because, if you think back to last year when he would do these press conferences, he was always talking about how they were going to measure success in large part based on the developments that they would see in the labor market, including potentially a somewhat higher unemployment rate. And now they're kind of shifting away from that because they've realized that that's not how this cycle is going, but now they don't seem to be sure exactly what is happening. And so I think that I increasingly get the sense, listening to the speeches that they give or these press conferences, that there is some growing confusion about what effect their policies are having, and that will mean that there will be a lot of uncertainty about when they need to stop.
Well, I think they're going to stop, and at least for now. And it's really interesting when you look at the financial markets. They have forecasting markets, which people make estimates, bet money that suggests when the Fed will actually cut rates. And some of those forecast markets are suggesting that the Fed could begin cutting rates as early as July. That strikes me as way too premature unless we're in some significant difficulty in the financial system. Let's turn to the banking system and the banking problems. Jerome Powell, at his press conference that Joe alluded to, saying that all is really hunky-dory. Let's listen.
Let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode and will work to prevent events like these from happening again. There were three large banks, really, from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress.
Well, draw a line under this period of severe stress. I guess it depends, Kim, how you define severe stress. It's true that the main three banks that were the biggest problems have been resolved, but literally within hours of Chairman Powell's statements, we had regional banks come under enormous market stress. PacWest Bancorp, in particular, shares have fallen 50%, and said that it is looking for new strategic plans. We don't know what that means exactly. Looking probably for some kind of investment, perhaps capital addition, perhaps a merger partner. We don't know. And I guess the question is, how do you explain the confidence expressed by Powell and Yellen and the anxiety that's apparent in financial markets?
Yeah, I think what you are seeing is actually some investors looking at some of these other banks and worried about what they see. You look at PacWest, and this share price plunge came after it was reported that it was looking to do, as you say, some sort of deal, maybe to sell part of its loan portfolio, looking to sell assets, maybe a tie-up. There's a lot, and that made people very concerned. And of course, this is another one of those banks, very much like SVB and Signature Bank and First Republic. Here's one of the things that they have in common: a lot of large unsecured depositors, a lot of business with technology companies for PacWest, much like Silicon Valley Bank. And PacWest, I give it credit, it has attempted to reassure people by saying that its FDI or insurance covered about 75% of its depositors, that it had access to cash and other funds that was worth twice the amount of its unsecured depositors. So trying to calm the outflow in depositors and also to stop the share price plunge. But it's not working. And I think it's in part because people in the market are also seeing some very unsettling things about the number, especially of mid-sized lenders out there that are really drawing very heavily on some of these Federal Reserve funding facilities, and asking what that means in terms of what they're holding and what kind of investments they've made and how sound their business model is. And I'm not quite sure that just those three banks are the only problem here. I think that there are more banks out there that have engaged in similar practices. They might not be as big or consequential, but that's, I think, what the market's looking at the moment.
Joe, there's the issue of interest rate risk, which we've talked about before and is obvious, which is that banks have a mismatch between assets and liabilities on the interest rates. As interest rates soared as fast as they have in a year, Some of them, like Silicon Valley Bank, were caught on the wrong side of that match. But there may also be some credit risk out in the markets, particularly in commercial real estate, which a lot of loans made before the pandemic are going to have to be renegotiated. And you obviously have a lot of space in big cities, which isn't being used. There are going to be some big losses, I think, banks will have to absorb on their income statements. And there may also be some on residential real estate, depending on how long this period of high interest rates lasts. So I guess my own view is that when you have 15 years of easy money, particularly, near zero rates. And then suddenly the Federal Reserve has to jack up those rates by 5 percentage points in a year. You are going to have all kinds of casualties. It always happens in history. You can't have this kind of incentive for leverage taking on debt, for essentially almost a subsidy for credit with negative real interest rates. And then when the music stops, not have casualties. And I think the surprising thing to me so far is that we've had relatively few. And I suspect there are going to be more.
Exactly. And I think that that's really the key to understanding where we are in this process, because I think it's entirely probable that we will end up with different phases of this. And in fact, it may sort of be true that the first phase has ended, because, that first phase was with these large banks, mostly out west, that were experiencing huge deposit flight. Well, it's true that the deposit flight phenomenon has slowed down, and in fact, that doesn't even appear to be the precise problem that Pacific Western is having right now, as they experience their troubles in the marketplace. And so I think that it's probably entirely true when Jay Powell or bank executives say that the deposits have stopped sloshing around the system in the way that was creating the problem in March. But that was only ever a symptom of these much deeper problems that you're talking about. And I think that the next phase that we're coming into is going to be the continuing workout of some of these interest rate risk problems. And then the phase after that is probably going to be the point where we start understanding the default or credit risks that might be lurking out in some of those areas. And I would only add to that along the way, we might also discover that there's a phase of this where the problem turns out not to be confined to the banks.
Right. This would be the non-banking financial system.
Exactly. In the United Kingdom last autumn, we already had a mini financial crisis that was triggered by pension funds as they made the very painful transition from an ultra-low interest rate environment to a more normal interest rate environment. And so I think that it might be too narrow to think of this process that we're going through as a banking issue, because there are going to be a lot of other asset managers, non-bank financial companies that are also going to have to make these adjustments, and that might constitute one or more phases of this process as we go along.